Hello, investors and traders, and welcome to the midweek report. I'm AJMonte, Chief Market Strategist with Sticky Trades, and the markets have just closed. We had another exciting day, and I have a lot to share with you, so let's get right to the charts. If you look at DIA, you can see that we have this little small body candle right there that closely resembles a shooting star. It's a small body candle with a shadow above the body. But most importantly, if you look at where that shooting star is showing up, right at a key resistance point. So if you take out your trading checklist, you'll see at resistance, we also see a drop in volume that is bearish. We see this wide divergence from the moving average. That too is very bearish. If you look at the oscillators down below, we have the stochastic hinging lower, almost with a sell signal. I think that will happen tomorrow. And we have a hinge on the CCI. Most importantly, we have a negative divergence. Look, we have a much higher price high here, but we have lower highs on the CCI. We had that happen back in July, lower CCI highs with higher prices coming in, and the markets dropped significantly from there. We dropped 3,000 points in that period of time since that negative divergence. So I think that we are still heading lower. I think there's a good chance we're going to move back towards the gap between now and Friday. Whether or not that gap fills, we'll have to see, but there is an extreme possibility that that could happen. Now, looking at IWM, this was the only ETF that I was going up with, at least at the beginning of the week. The market did go up Monday and Tuesday, and what happened here, we popped up yesterday, continued higher, but we have another shooting star. This is a very well pronounced shooting star, but the most important part about that is that that fills the gap officially right there. Gaps being filled, you will then see 80% chance that the price will drop. So that gap fill will now repel the price lower, while the gap below the market will draw the price lower. So we have more or less a push and pull between the gaps right there. And with that negative divergence on the stochastic and the hinge on the CCI, again, I think we are going to start moving lower. So that's IWM. I'll put my final targets out on Friday, but as of now, all targets are still in place to the downside. If we look at QQQ, you're going to see a little red candle there that closely resembles a hanging man on lower volume, with the oscillators moving lower and almost crossing here. That gap below the market is very interesting. We have another gap below the market here. We have another gap below the market here. I'll talk more about that when we get to the SPY, but I think that we are going to pull right back into the battle of the number 5 fan line. I think we're coming right back like we saw back here back in October, so stay tuned for that. You option traders are probably chomping at the bit as we get closer and closer to expiration Friday. I'll be putting out publications that cover our ETF positions, so stand by to your member page for that. Looking at SPY, you'll see that we have similar gaps. We have a gap back here earlier in November. We gapped up. That is called a breakaway gap. Then we gapped up again. That is called a runaway gap. And what we have right now is called an exhaustion gap. And I'm about to give you another guarantee. Ready? Well, exhaustion gaps fill 100% of the time, at least for the time that I've been tracking them. They are very rare that they even come up at all, but because that is the most extreme gap, hence the reason why they call it an exhaustion gap, the market tends to get exhausted after that third gap, and then we see a retracement and a pullback to fill that gap. Now, if I take this little diagram of this textbook example of how the gaps work, and I just sort of minimize that, let me just minimize that and move it to the side here. What do we have? You'll find this very interesting. At least I hope you do. The breakaway gap was right here. The runaway gap was right here. And what do we have? The exhaustion gap right here. In addition to that, if you take out your trading checklist, you're going to see that we have that wide divergence from the moving average after, yes, another gap fill up here yesterday. So we have that push and pull of the gaps. pushing it lower, drop in volume after that wide divergence, oscillators pivoting lower, and therefore I'm giving you a guarantee, 100% guarantee that that gap will fill. Everyone always wants me to tell them when. We never know the whens. We just don't. It could take 5 days. It could take 5 minutes. We don't know. Tomorrow could be a big down day. It might even gap down tomorrow. We don't know those things. Those are the unknowns. But what I do know is that from history, 100% of the exhaustion gaps have filled. Don't take my word on that. Go back and look at exhaustion gaps. Even if you can find them, they're rare to find. 3 in a row like that all continue to stay open. But that is what we have. Now, I want to go to the VIX. VIX is the ticker symbol. My guarantee is still in place that that 1 penny gap will fill. We had very close to a bullish harami today. We have the buy signal occurring on the stochastic. We have the wide divergence from the moving average. We're right at a key support level down here around 13 for the VIX. I think that will move higher. This one is most likely to hit first. This upside target, that is most likely to hit first before the downside target hits on SPY. Now, before I wrap things up, I want to talk a little bit about SLV. I make my silver trading very public. You may recall that on Twitter, I made the announcement 2 days ago that I was buying back my position for $20.16. So I bought back into 100% of my silver position. Bought more shares, not a whole lot more, but at least I bought more. That's called parlaying the position. Now, because we're at that resistance level on lower volume with a gap up as well, and the oscillator is starting to hinge, today I made the announcement on Twitter, so all of you are following me, and maybe some of you are trading with me. I sold out of 5% of my SLV position with the objective here to buy it all back and more once that gap down below fills. So keep an eye on that. That level's right around $20.50. I might buy that all back at $1 lower, buy more shares, and continue to parlay and have fun. This, again, is very fun to trade because it's not making huge moves that are going to break the bank. Of course, if you're trading in moderation, you're not risking a whole lot. But even if you are trading a little bit bigger than normal, I would say follow my 1% rule for managing risk. That is one of the free videos that we offer on our Sticky Trades membership. Yes, we have a free membership that will allow you to watch the 1% rule video and track along with these market reports. And you will also have access to my trading checklist that I often refer to and use every single time when I'm looking at a chart. Finally, from 6 to 7 tonight, we have the rapid fire stock analysis session. I will analyze at least 40 to 50 stocks in that 1 hour, giving you price targets for all you members that submit a ticker symbol. It's one of the best times of the week for me. I have a lot of fun. It's exhausting, but I have a lot of fun, a lot of energy, a lot of excitement on that call. Hope you could join us. Until then, I'll talk to you on the next video. So long.